All right, today we are diving deep into the world of high-frequency trading to crack a very important code. We're going to be exploring what's called the VARMAX model. Now, this is a seriously powerful tool used by some of the top hedge funds on the planet. And our guide through all this is the work of Dr-Eng-Prof Yogesh Malhotra. So let's get right into it.
You know, it really all starts right here. This quote, it gets to the heart of the challenge. In today's markets that move at the speed of light, how on earth do you model the dance between millions of trades and these tiny, split-second price movements? Well, the answer lies in a powerful method called the Vector Autoregressive model, or just VAR for short. It's really our key to understanding the market's secret language.
So, before we get into the nuts and bolts of the model itself, let's talk about the problem it's built to solve. Dr. Malhotra's work frames this beautifully around these fundamental questions of what's called market microstructure, which is really just a fancy way of saying the hidden mechanics, the plumbing of how the market actually works.
This is the first giant mystery, isn't it? A news story breaks, a rumor starts to spread, some big firm makes a move. How does all that stuff, that feeling in the market, actually get baked into a stock's price, second by second? It's not magic, there's a process to it, and that's exactly what we need to decode. And then, of course, you've got the practical side of things. For any trader, the question that's always on their mind is, when do I pull the trigger? A truly optimal strategy isn't just a lucky guess. It's a super precise, data-driven decision that's based on understanding the market's own internal rhythm.
And here, this is where the stakes get incredibly high. See, understanding these tiny, micro-level mechanics isn't just about making money. It's about stability. How do we stop things like flash crashes and these other huge systemic failures from happening? The clues? They're buried deep inside the market's machinery.
So this is the world we're playing in, market microstructure. As Dr. Malhotra's presentation defines it, we're literally looking at the fundamental mechanics of how buying and selling actually happens. We're talking about finance at the most granular, nitty-gritty level you can imagine.
Okay, so we've got these incredibly complex questions about how markets really tick. I mean, where do you even start to look for answers? Well, the big breakthrough came from using a really powerful statistical tool to see the market not as just one thing, but as this massive, interconnected conversation. And that tool is Vector Autoregression, or VAR. Think of it like this. Imagine the market is a big group conversation. Now, if you want to predict what one person is going to say next, you wouldn't just listen to what they've said in the past, right? No. You listen to everyone's past comments because all of their statements influence each other. Well, VAR does the exact same thing, but it's doing it with streams of financial data.
So the core idea is actually pretty simple. Everything is connected. As you can see here, past trades have an effect on the current price. The price's own history also affects where it is right now. And even past trades influence current trades. It basically treats the market like a living, breathing system where every single action has a reaction.
Now, a VAR model on its own is incredibly powerful, but we can make it even better. The guidance from Dr. Malhotra shows us exactly how to supercharge this model, and it all comes down to adding one very crucial letter, X.
This lays out the upgrade perfectly. A standard VAR model, it analyzes the market's internal conversation. But VARMAX, and that X stands for exogenous variables, it also listens to what's happening outside. This could be anything, broad market movements, breaking news sentiment, you name it. It just makes the model so much more realistic and way more powerful.
Okay, so this isn't just some abstract theory. In his work, Dr. Malhotra details how this exact model is applied to real-world data to get proven empirical results. So let's take a look at how it actually works in practice. The analysis essentially boils the entire market down to two key signals. First up is R, which is really just the change in price. Is it ticking up or down? And second is X, which measures the trading pressure. Are more people buying or selling, and how big are those orders? Together, these two variables show us exactly how trading activity pushes prices around. Now, don't worry, you don't need to be a programmer, but this is a little peek at what the engine looks like under the hood. This simplified bit of code just shows how analysts use the VARMAX model to connect our two variables, the price change and the trading pressure, over time. And this is the exact kind of analysis that was run on data from huge companies like GE and AT&T.
So, what did the model actually find? This right here is the big payoff. The analysis empirically proved that a surge in buying pressure doesn't just bump the price up for a split second. It actually causes a persistent increase over time. So the key takeaway is this.
Trades are not just random noise, they carry real, actionable information that actively moves the market.
Okay, so what does all of this actually mean in the real world of high-stakes finance? Why does building a model like this matter so much? Because we're talking about this kind of scale. According to the source material, this modeling guidance from Dr. Malhotra was developed for a Goldman Sachs alumnus hedge fund with assets somewhere in the range of $400 to $500 billion. The stakes just could not be higher.
And that makes it crystal clear. This is not some academic exercise. This is the absolute foundation of what the pros call alpha trading strategies. Alpha is really just a simple term for profit that you generate from skill, not just from riding the market's wave. This model is how you move from just a gut feeling to pure data science, finding those tiny, persistent patterns that create that alpha. And that brings us to our final thought here. The VARMAX model gives us this incredibly powerful lens to look into the market's recent past, but it's also a critical launching pad. Dr. Malhotra's current research into AI quantum networks is pushing this frontier even further. So think about it. If today's models can find this much information hidden in past trades, what kind of secrets will the quantum-augmented models of tomorrow unlock? That is the question that's going to define the entire next era of finance.